I hope you all enjoyed the 3-day weekend. We've got a holiday shortened trading week this week, and I wanted to check in on the two things that we have been paying extremely close attention to here over the last month or so, and that is the US dollar and bonds. Those are two things the market's paying very close attention to, and so I want to check in on those charts. And then what I wanted to do is I wanted to take a 40 to 50 year look at the S&P 500 and take a look at some of the past bear markets that we've had and look at the price action that we have seen so that we can perhaps get a gauge of what we could be in store for moving forward. Now, the US dollar, this chart is a 10-year chart that we've got up here. The zone that we've been watching is that 103 to 104 zone, and we had that as our resistance zone, our high from 2016 and 2017. We pushed back up into it on that spike in 2020, and that acted as resistance. Now, I'm going to zoom in a little bit so we can get a better view of this year's action. We made that break above, which was immediately sold under. And so what we had talked about was any more weakness down in here, you could have looked at this as a potential false breakout. However, dollar held on to that 101 zone and made that strong bounce, made a new high, and has back tested that 104 breakout zone, which has held. The key to this chart is going to be a move over 106 for a continued move to the upside. And if the bears are going to have any claim to fame here on this chart, they're going to need to drive the US dollar underneath of that low from the mid-May, which would be under that 101. As long as we stay over 104, the bias and trend is to the upside. And clearly, if we make a higher high, that would be a very strong indication that we are going to continue to see strong dollar prices. Next up, I want to take a look at bonds. Now, I'm going to back this up, and we're now going to switch to a monthly time frame, and the rest of what we're going to look at is going to be on monthly time frame. So I'm going to switch to a percentage-adjusted scale so that we have a much clearer view over a long time horizon. This chart here goes all the way back to 1998. 97, 98 in here, and you can see we clearly have had a series of higher lows going all the way back to 2000 until we took this area out and took out the low from 2018, 2019. Right? Bonds, we had that head and shoulders topping pattern with a clean break in the next line here this year, and it has been down hard for 3 straight months. The last area really of support in the last decade is right here, and that is the zone that we're watching very, very closely. We made a sharp bounce. I'm going to zoom back in on a daily chart so you guys can see this. Last week, we had a pretty sharp bounce on the Fed announcement day, but that was faded. The next day, we didn't take out the previous day's high. The next day, we didn't take out the previous day's high. So if you're looking at this as a potential bottom above that major long-term support level, you're going to need to take out the high from the Fed day right here and continue to push. Because right now, over the last month, it is still that clear lower highs in play, and we clearly still have lower lows in play. All right. A move back down, taking out this low, would obviously be extremely weak price action, and that would mean rates are once again on the move to the upside. So what happens down in here is really, really important, and it is happening, right at a major long-term potential price support zone. Right? This is from 2013, this area right in here. So 10-year support is what bonds are testing, and we're going to continue to pay very close attention to what's going on there. So let's talk about the S&P 500, and I got my chart now going all the way back to the early 1980s. And 87 was a very unique occurrence because it was that major flash crash, and it was immediately bought back up, and the markets continued to grind higher. So there wasn't a ton of price action. It was really just an extremely sharp, quick sell-off that was immediately bought back up. Right? Over that 20% line, considered a bear market, but really it was 1 month candle down essentially, and then it was that grind higher again. Our real bear markets, where we have prolonged periods of decline, is that .com 2000 zone and our 07 to 09 financial crisis zone. Our 2020 sell-off was very reminiscent of that 87. Really quick, sharp reaction, and then a big move higher, right? The question that we continue to have to ask is, are we going to see that quick V-shaped rally? We've seen it a number of times here over the last decade or so. After we had this really sharp decline, the Fed stepped in and we had that huge rally back up quickly off of these lows. Is that going to be the price action that we have, or are we going to see a much slower, longer grind higher? Remember, 2000, it took all the way back essentially to 2007 to get to that same spot, and you had a basically decade-long double top was what that price pattern is. Now, again, when we look at this on a percentage basis, right, this is not the biggest percentage move, right? 2020 was bigger. You can see that. This was a 35% pullback. This right here is about a 25% pullback, right? So we still have another 10% to even get to that same zone there. We had that 18, 19. That was about a 20% pullback. And then in 15 and 16, we had a couple of 15% pullbacks, 17% pullbacks. Didn't get to bear market territory, but were still pretty decent. And then in 2011, we had that 20% pullback. In 2010, we had an 18.5% pullback. So we had a protracted long bear market in 2000, protracted long bear market in 2007. We technically had that 20% here in 2011. We did not reach it here, and we did get that 20% pullback in 2020. So as you can see, these pullbacks, these big moves to the downside, don't happen that often, right? We go back to 2000, we've got 1, 2, 3, 4, and now 5 times that we have seen this happen. When we look at previous major pullbacks, let's put some major levels of support on the charts. Where do things ultimately pull back into? Well, if you look at that 96, 97 breakout zone, right? We had this runaway move from this breakout right here. And when you put that major level on the chart, that happens to be where we kind of found that bottom. And when we zoom in, we actually put in an inverse head and shoulders setup where we had a low, a lower low, and then a higher low, and then we made that break. When we come back and we take a look in at the 2007, when we extend this out to the right, we find that that same price support zone was important, right? Price is a memory. And here we are pulling right back into that zone. When we take a look in at 2020, 2020 pulled right to a major important key level. The breakout area from 2016, 2017, right? Here's our breakout zone right here, making that move up. We tested it once in 2018. We tested it again in 2020. Market wasn't able to break that, pulled back up, and made that rip higher. As you can see, most of these pull back into a previous level of major support. Where is our major zone of support? Well, it is going to be that 2020 breakout zone, right? This breakout right here was resistance, and now it should act as support. And you can see we're coming right into that zone. Now, for your understanding from a percentage basis, right here to the bottom of this zone is still another 13%, right? So are we going to bounce from the top end of that support zone like we saw back here? Are we going to go and test almost the bottom end of the support zone here? Are we going to bounce like the top end here? Are we going to test the bottom end of the support zone like we did here? Somewhere in this zone, we should see some sort of bounce. It doesn't mean that that's going to be the end of it, right? Because if we go back and we look at the major levels on these two major market tops, we have an area right in here from this previous breakout where we get a bounce and then we roll over even further. Same thing in 2007. We get a bounce off of this zone and then roll over even further. So a bounce does not mean it is the bottom, right? It could be a bottom for a short period of time. And when we zoom in and we look at the daily price action here on the S&P 500 this year, we've had some pretty decent sized bounces that have rolled over, right? So a bounce here makes perfect sense. The key to everything is, can we make a higher high? Because we have not done that. We have continued to make a series of lower highs. So if we watch the market make a 5 or 10% bounce from here, it doesn't necessarily mean that we're out of the woods yet. All right, to take this high out, we are going to need a 12.5% bounce from where we are today to make a higher high. Now, bottom line, you should not be getting FOMO on a 3 to 5% bounce. We should be paying very close attention to price action and wait to see if we can make those higher highs and get some real clarity on that move. A bounce right up into this zone right here could easily just be another lower high before we make another rollover. Let's continue to utilize that definition of an uptrend and a downtrend. A downtrend is a series of lower highs and lower lows. We still have that in play, and as long as that's in play, we have to be cautious and protectionary towards our capital. When that switches and changes and we start making higher highs and higher lows, we can change our stance. But that hasn't happened yet. And again, when we take a look at things from an historical basis, right, we could see that big V rally like we saw in 2020, or we could be looking at that longer protracted bear market. We don't have the answer to which one of those it's going to be. What I will say, market bottomed on Fed activity, right? Fed stepped in here in a major way and started QE. Fed stepped in right here in a major way and did those PPP loans and sent money out to everyone. Fed is not stepping in here. We're still raising rates. So seeing a short-term bounce and a continued rollover until the Fed does something to change their policy stance would make some logical sense. Bottom line, we're going to pay attention to what these charts have to say. We're not going to listen to what the financial news media and pundits have to say. We're going to pay attention to what price is telling us. And right now, even if we get a bounce right here, until we take out that 412 or 4200 zone, we don't have a higher high, and we have not broken that downtrend. As always, I hope you guys found this information useful. If you got any questions, feel free to reach out to me at mtedeschi at Perspective Wealth Planning, or give me a call at 814-580-9881. I'll see you guys tomorrow. Take care.